This is our video blog for May 11th, 2011. And like most days, you really want to bring up the currency meter and the top. This shows each individual currency, the dollar, yen, and all the bottom pairs that we typically trade against the top pairs. And the top one shows the real-time strength or weakness. Red is weak, green is strong. Anything at or above or near the white line shows extreme strength or weakness. And in a perfect world, you want to look at the daily, weekly, and monthly statistical trends underneath and mostly focus on the weekly trend. You can see the dollar has a slightly up weekly trend. The monthly trend's still down. The daily trend was down until about 9 today. Um, you know, the best currencies to trade are ones like the Australian, where later on today it actually was going through a downtrend, but it had a daily, weekly, and monthly trend that was up most of the day. If it had real-time strength today as well, those are obviously the highest probability trades. If all three of them don't line up, my preferred longer term trend to focus on is the weekly, and that's the one in the middle. So you can see in the CAD here, daily trends up, weekly trends up, monthly trends down, but the weekly trend is pretty strong. So when you start seeing that have some real strength right here at 2, you want to look for buys in this. Now at 2, the dollar was weaker, the weakest of the two pairs, so you certainly could look for dollar CAD sells at 2 o'clock. Let's bring the dollar CAD up. Here's 2 o'clock. And one of our rules is when price is underneath the hourly moving average, that's the gray line in the middle of the chart, you want to focus on sells. You can see this one already sold off yesterday, and it had 2 narrow range patterns in a row. You might have gone short right here, and you would have probably gotten stopped out with a 5 or 6, 7 pip loss. Same thing again here. And then when it finally broke down, this trend at 2:30 showed you the dollar is weak, somewhat weak, and the CAD was strong. It took it about an hour before it finally made its move, but eventually it fell 10, 20, 30, 40 pips right to a Fibonacci profit target level that I draw overnight. There was another Fibonacci level right underneath that, and it's also our lower containment bands. One of the new tools that we just released last night is called FX Tipping Point Tick, and it lets you see the percentage of currencies that are going up or down during this time. So let's look at that on a scalping tick chart here. When it broke down that last time, you can see initially there wasn't really extreme weakness during most of those drops other than one bar here. It came really close to what we consider extreme, but never really hit it until right here. And then the market just tanked, and we had a little bit of green here, nothing significant, but you never know when markets are going to continue or not. You yank your stop down there, and typically anytime you're in a nice decent trend, the market will make at least 2 waves, so you can draw your fibs off the first one, and you're at the Fibonacci profit targets intraday as well as my Fibonacci profit target from yesterday's move. And as you can see, as it got down here, there was quite a bit of weakness, and then it kind of disappeared right here. So if you wanted to get out of your trade right here, I certainly wouldn't have blamed anyone. But as long as you see extreme weakness when you're in the trade, even at a likely reversal area, you stick with it until that weakness kind of disappears somewhere around here, and you get out of that trade. Again, you made probably 30 or 40 pips on that trade. You might have got into a trade or two before that didn't work, and with this tool at least, you would have known it. Now watch. This is probably where you would have sold that breakdown, and initially there was a lot of weakness on that bar. Then on the next bar the weakness is less, and then on the next bar there's no weakness at all, and you see came back up. So if you got short right here, it went only 2 to 3 pips your way, and maybe your stop on a tick chart might have been right over here. You saw almost no weakness, and it started to come back up with quite a bit of strength, and you could have got out of this trade with a 2 or 3 pip loss. And that's the beauty of this new FX tipping point tick. It really lets you know on a real-time basis, sometimes within seconds of getting into a trade, whether your odds are good or bad. Let's go back to the currency meter. Later in the day, the dollar, was relatively consistently strong, and you would have wanted to trade it against one of the weaker pairs. The euro's daily, weekly, and monthly trends down. The dollar's weekly trend is just slightly up, and it went back and forth, for a while because it was right at the tipping point of that. But the euro was weak, the dollar was strong, and the dollar was stronger than the yen. So after 6 o'clock, selling the euro dollar was a good thing to do. And notice earlier today, it had trouble getting to and going above the previous day's high. We have a counter trend sell signal right here. This is a double stat high or a 4-hour statistical range high area. There wasn't that much statistical strength on it. And if you bring up the tick chart, let's look at this up here near the high. Initially, the first time up, it had pretty decent strength. Then it pulled back with quite a bit of weakness. And on the way back up there, with a little double top right here, notice the strength is far less than what it was before and less than what we consider an extreme amount. So aggressive traders might have kind of waited for this low here to get broken. And when it started to fall right here, notice not extreme weakness like before, unfortunately, right? And you're only up a few pips in this, or you might have had your stop above the high here. Whether you got in this trade and out with a 2 or 3 pip loss or break even and then had to re-enter, or on the way back up here, notice there really is no strength whatsoever on that 2-bar up move, right? So there's really not much to be afraid of. Your initial stop probably would have stayed there, and as it starts to come down again, notice not a whole lot of weakness until about right here. At this point, the euro is starting to fall and the dollar is getting stronger, and therefore it's likely to go to the next support area, which is the hourly moving average. You short here around 15, maybe out at the hourly right here, and most of the time people like to buy it to hourly, but when it's weak like this you don't. But when the weakness kind of disappears and you can see upswings with more strength than downswings, you might want to give a shot to it. Once you're in this trade right here, notice initially it's looking good, and then it's looking good, and then there's a little bit less strength right here. And you got to always move your stop up whenever you see some red bars. You got out of that with a small profit. Now the next wave down, we finally have pretty extreme weakness compared to the first one, a lot more weakness. And as it's going sideways right here, there's no strength whatsoever. So the odds of this getting a bounce off the hourly again is far less. A lot of times when the hourly gets hit and the market fails to get a bounce off of it. Now remember, coming up to 6, the dollar was starting to get strong and the euro was one of the weakest currencies. So we wouldn't want to buy the weakest currency. It doesn't make any sense. And this tool gives you a really second by second reading of what all the euro dollar pairs are doing on tick charts and what all the dollar pairs are doing. So you go short right here and you can see initially it starts to fall, then it gets less so. You might have got out of that trade with a small scalp profit, and you can also use it for longer term trades if you want as well. If your goal is to catch bigger moves and not just take 5 to 15, 20 pip moves, draw your fibs on this, and you might have gone short here with either a small win or a loss, gone short again here. And as it's coming down, if you see a lot of weakness and in comparison to the up moves, lack of strength, you just keep tightening your stop. And let's see if it got down to the fib target down there. All right, it's coming down to the fib target, and look, quite a bit of weakness on that bar. So it's probably pretty likely to go through that fib target. If you see it come down there with less than the 0.4 dotted line weakness, you might want to exit half your trade here. All right, it broke down. It's losing some of its downward momentum. So I probably exit half my trade somewhere around here, and get out of the rest of the trade right here at 66. It's a good 20-25 pip profit from this level right here, using the currency meter, fib tools, and also the new FX tipping point tick, which shows you basically on a bar by bar tick basis what all the euro dollar pairs and in this case dollar pairs were doing. The pound was very strong today. Unfortunately, the weekly and monthly trend were down. You'd want to trade that against one of the pairs that's weak. At 5 o'clock right here, the dollar was weak, and the yen was weak. Let's look at the pound dollar at 5. Now the dollar very soon afterwards became strong, and you can see this was above the hourly and broke out right here. Let's look at this. This was a really explosive move. This new tool would have really helped you, stay into that move on the way up when it broke out. Let's scroll back and look at this. Notice as the market's kind of chopping around here, and it broke out over the sideways multi-hour range, just incredible strength coming in here. And usually you don't want to buy a small 10 pip pullback. 20 pips is fine. This thing kind of pulled back right here, and then all of a sudden, got relatively strong. You might have bought that breakout right here, and if you weren't in that first move and caught that 40 pip move up. And as this thing's going up right here, initially there's a little bit of strength and then a little bit of weakness, so that's an early warning that this trade may not work. Goes up again, there's some strength right here, and all of a sudden the strength kind of disappears. You tighten your stop underneath there and you get out with a small profit. You get back in the next pullback down, because this was an extremely strong move up. It's very likely to give you a profitable trade. It pulled back initially with a little bit of weakness, less, right? And that's usually a good sign. On a tick chart, you can actually get into this trade right here and anticipate a possible trend line break, and you're in the trade a little bit earlier. This thing goes up, and notice initially a lot of strength. It falls off right here, and if you're a scalper, you might just take your 4, 5, 6, 7, 8 pips right here and wait for it to see what happens. It comes back down, the weakness is no longer there. You buy the breakout again, and this one really took a while before it really went up again. But with the exception of the weakness coming in right here, typically how I plan on using this is anytime I see a lot of weakness like that, I'm in a trade, I'm going to yank my stop up underneath the sideways range, and then the strength comes back, and you can see the up moves are, there's more dynamic, there's more broad-based moves to the upside than there is moves to the downside, which means as the bars are going up, a higher percentage of pound pairs are going up, dollar pairs going down than on the down moves. And you can just, every time it makes a slightly higher high, yank your stop up. But as long as you see greater intensities of the green bars and the red bars, you want to stick with it. And typically, markets, when they get to the upper containment bands, and here's a Fibonacci area, it's usually a good place to consider getting out of the trade. I'm just doing our video blog right now, but I will be going over these tools in more depth in class. The Swiss weekly trends down. It had quite a bit of flipping back and forth from the strength to weakness. I prefer, you never know in real time if that weakness is going to continue or if it's going to only last an hour or half an hour. But the Swiss was weak and the dollar was strong, so after 6 you could look to buy the dollar Swiss. Here's 6 o'clock. The market's just kind of chopping around, and price for the most of the day is underneath the hourly. So when it came back above the hourly right here, you might have went long, and that trade obviously didn't work. The second time up, it did, and the pullbacks that you got on the way up to the Fibonacci area and likely high, it kept making higher highs and kept going up. Using the new tool on the tick chart, let's look at this. That first trade when it went from underneath above the hourly failed. Let's look at how this tool would have helped you. Alright, so let's say you got into this trade right here. Kind of comes up to the hourly. I don't flat out buy the breakouts from underneath above the hourly, but if it does, pulls back and goes up again, you might give this second one a shot here somewhere around 88.02. And as it's initially going up, there's a lot of momentum, and then the momentum kind of dies out. So whether you got out of that trade here with only 2 or 3 pips, the pullback right here had very little weakness. It makes sense to buy that right there. And on the way up again, we really didn't have the peaks in the intensity that we had before. And as it's kind of going sideways right here, your initial stop when you bought the breakout would have been underneath those lows. And as it goes up and kind of makes a little bottom right here, you yank your stop up underneath here. Notice there's not a whole lot of weakness. But as it goes up again, there's no strength whatsoever. It never even comes close to this line. So you had every opportunity to get out somewhere around 88.07, 88.06, and even after the spread, make a pip to 3 or 4 pips, depending on how big your spread is. Now the second time up to the area, and again, you don't want to just buy when it comes up here. Kind of wait and see what happens. A lot of times they chop around here. If you wanted to buy it the second time up right here, that's fine with your stop just less than 5 or 6 pips underneath it. Notice initially a little bit of strength, not obscene strength, but enough to keep you into the trade as it's going up here. And then during these bars right here, you see a little bit of weakness come in, so you want to tighten your stop underneath there. And you always want to draw your fibs on the first wave up, and because most of the time the 1.382 fib level is where the end of the move is going to be. I usually use profit targets on 25 to 30 pip or more moves. This one's kind of tiny, so it's more likely to hit the second fib level. This one was coming up with decent strength. There's a little bit of weakness here. It goes to the next fib level, and when it runs out of steam right here, you might want to get out of your trade here at 20. So that's about an 18 pip profit on that trade, using these tools to kind of give you a little bit more feel for staying with the trade. So that's it for today's Forex blog. Come to our classes to learn more details. I just record quick Forex blog to show how our currency meter and everything works each day. We've done this since late November. There's over 100 days worth of past examples of our software in action, and if you watch those, you should be able to make up your own mind if it should help your trading or not.